Okay, why don't we go ahead and get started? And I thought maybe we could maybe have each of us introduce ourselves quickly, and then we can go right into the presentation itself. So Bob, do you want to start?
Sure, that'd be fine. Good morning. My name is Robert Zink. I'm a real estate broker and a securities broker on this presentation to represent the various DST providers. If you are interested in a DST to fulfill an exchange need. So DSTs, as we'll learn this morning, are available as an exchange option, and Bill and John Bacigalupi will talk about that more. I've been a real estate broker for 50 years and a securities broker for 10. So back to you, Bill.
A lot of experience there.
Yeah.
How come you have more hair than I do?
I don't know, and my dad looked just like you, so I just got lucky.
What happened there?
Yeah, I don't know.
Gotta love it. And John, you want to go next? John,
yeah, thank you.
These are our official.
Yeah, so I apologize. I'm the one dealing without the video here, and especially when we're talking about hair, I have a beautiful head of hair you guys can just imagine. But thank you for the opportunity to speak with the group today. I've been in the securitized real estate world for approximately 15 years. I work for a company called Cantor Fitzgerald, which is very large financial services company, and they own a real estate company called Newmark, top 5 full service real estate company in the United States. And we think we are an excellent provider of Delaware Statutory Trust. So today, after Bill spends some time kind of going over the 1031 exchanges, I'm going to talk a little bit about the Delaware Statutory Trust, why it makes sense in general, and then also just where we're at right now in this pandemic, hopefully more towards the end of it. We are seeing that active management through the Delaware Statutory Trust is what a lot of investors want, that institutional hands-on management. So I'm going to talk a little bit about that, and then we'll have some Q&A at the end. So Bill, back to you.
Sounds good. And Mark, you want to go next?
Sure. Mark Turok with Exeter 1031 Exchange Services. I'm their business development officer in the Southern California, San Diego, Los Angeles, Orange County markets, and here to support the team here and build today. And if you guys need any or have any questions after the webinar, feel free to reach out to me, and we'll provide our information later on. Thanks, Bill.
Perfect. Thank you. And then for those I haven't met before, my name is Bill Exeter. I'm the founder, president, CEO of Exeter 1031 Exchange Services and Exeter Trust Company. And this is now going into my 36th year doing 1031 exchanges. So we've seen a lot of exchanges over time. And what I thought we'd do today is, at least the first part, when I'm my presentation, we named it the Unraveling the Mystery of 1031 Exchanges. We found that a lot of folks will call us and say, I've talked to 3 or 4 people, I got 3 or 4 different answers, and I am so confused, and I'm not quite sure what direction to go or what actually needs to be done. So this is really designed to answer those questions. A lot of the reasons for the uncertainty and the confusion is that the codes, the regulations, and the rulings don't really answer all the questions sometimes, or they create more questions, etc. And then what you get is answers in a lot of cases are people's opinions, but it sounds like fact. So as we're going through this, we're going to kind of cover those issues and what is fact versus what's opinion, etc. And our job is to kind of lay out the pros and the cons and the aggressive position and the conservative position, and really give you the information you need so you can make a better informed investment decision. So that's really our goal. So real quick introduction of the companies. Exeter 1031 Exchange Services is the qualified intermediary. We handle all types of exchanges, which covers forward exchanges, reverse exchanges, improvement exchanges, and even what we call zero equity 1031 exchanges. We handle all types of real estate, all 50 states. We're also one of the few exchange companies that will handle the exchange of foreign property. So if you're selling rental or investment property in a foreign country, you can exchange that for other rental investment property that is also in a foreign country. So we can take care of all that for you. We're one of the few qualified intermediaries that has any kind of government oversight. We took a number of years to go through the regulatory approval process and got licensed as a trust company. So all of the funds are held in separate, segregated, dual signature qualified trust accounts under Exeter Trust Company. All of those get audited every single year, et cetera. So that puts us up in that top 1% of qualified intermediaries that has government and regulatory oversight. So our real emphasis is more advisory and consultative. We can work with you and your advisors and kind of help walk through the entire 1031 exchange process. We've got a lot of experience in the area. You're always welcome to call and brainstorm, so feel free to call us and chat. Exeter Trust that I mentioned is licensed in Wyoming by the Wyoming Division of Banking. We have the Fidelity Bond, the Errors and Omissions Insurance, fiduciary insurance, and one of the more important things is that we administer qualified trust accounts, and we'll kind of get into that later. We also offer custody accounts, self-directed IRAs that focus on alternative assets. So that's kind of a quick overview on who we are. So let's jump right into the presentation. And again, I'll point out which slides are the most critical and which are the most confusing and explain why as we go. So of course, the 1031 exchange is all about Section 1031 of the tax code. It's really a tax deferral strategy. It gives you the chance to sell real estate that's held for rental, investment, or business use. And that'll trigger a capital gain tax and a depreciation recapture tax. It may also trigger or generate the Medicare surcharge or Obamacare tax. But if we can do this, do the sale and reinvest through a 1031 exchange, it allows you to defer those taxes. So you defer your capital gain tax, you defer your depreciation recapture tax, and you don't trigger the Medicare surcharge or the Obamacare tax. So it really is designed to keep the money in your pocket working for you. If you had to pay about 1/3 of your profit to federal and state agencies, that's really difficult to reinvest and trade up in value when you're losing 1/3 of your profit. You actually have to cut a check for that. So again, this keeps you from paying those taxes, keeps the money in your pocket, and helps you kind of reinvest in hopefully larger assets, more doors, more cash flow, et cetera. So that's really the goal. So it's certainly a transaction tool. A lot of people say, hey, I'm selling real estate, don't want to pay taxes, but it's more than that. It's a wealth building strategy. It's really designed to continually exchange and exchange and exchange over your lifetime. As long as you keep exchanging, you keep deferring the taxes over and over and over. And then when you pass on and you leave those properties, the wealth, the real estate portfolio that you've built up and the wealth you've built up, when you leave that to your heirs are going to inherit those assets at a step up in cost basis. So that's a fancy way of saying the capital gain tax goes away, the depreciation recapture tax goes away. Your heirs will pay no taxes on the sale of the property. And the reason for that is the value of all your assets are included inside of your estate for estate tax purposes. So they can't tax you on the estate tax and tax you on the capital gain tax. So that's double taxation, it's not permitted. So in this case, because it's part of the estate tax computation, they cannot calculate capital gain tax. And in most cases, most of us will never pay estate tax unless you're, a married couple gets about almost 24 million in exclusions. So you can transfer those funds over. So that's a huge planning opportunity where you probably won't pay any estate tax and you get the step up in cost basis and not pay any capital gain taxes. So we have a morbid sense of humor. The industry calls it swap until you drop. Keep exchanging until you pass on, and then everything goes away. So that'll be one way for you to remember that is swap until you drop. The next step, we're going to kind of go into the specific structures, and I mentioned them briefly at the very beginning, but with 1031 exchanges, you've got a forward 1031 exchange. With a forward exchange, you're selling first and then you're reinvesting second. And that's what 97% of our clients do. Our transaction volume is 97% forward 1031 exchanges. And then for the other 3%, they're reverse exchanges. And reverse exchanges allow you to buy first, and then you have time after that, 180 days to actually sell your current property. We'll talk a little bit about that, but we're going to focus mostly on forward exchanges since that's what 97% of our clients do. So again, forward exchange, sell first, buy second, reverse exchange, buy first, sell later. Now the reverse exchange does solve a lot of issues. It takes a lot of the risk out of the 1031 exchange process, because you can take all the time you want to go find replacement property, go under contract, close on that, and actually buy and close on your replacement property first, and then you sell your current property. And in today's market, it's certainly a seller's market, so it takes the risk out of that. The downside is reverses are a lot more complicated. A lot of lenders will not work with them. They're more costly, more costs involved, etc. So that's why you only see about 3% of those. We're going to have, John's going to talk about the Delaware Statutory Trust, and that could be a great solution to solve many of the issues with the 1031 exchange, and he'll cover those as well. So in a lot of cases, rather than looking at the reverse, you may want to look at a Delaware Statutory Trust and do a regular forward. The third type is not that common. It's the improvement, or other people call it the build-to-suit or construction 1031 exchange, which means you're selling an asset and you use some of the proceeds from that sale to buy a property, usually dirt, but you buy a property, and you use the leftover 1031 exchange proceeds to build or improve or retrofit the property you just acquired. The challenge with that is we have 180 days for the exchange period, so it's difficult to get a lot of the construction done during that time frame. One of the things I want to focus on real quick is the first step in a 1031 exchange, and that is you have to have a qualified intermediary involved. We literally get calls every week where they say, I closed escrow, or I closed with my closing attorney last week, and I just found out about the 1031 exchange. Unfortunately, once the closing occurs, you as the investor have the right to receive the proceeds. So even if you tell the closing agent, don't disperse the funds, I'm going to do a 1031 exchange, it's too late because you have the right to the funds. So you need to have your qualified intermediary in place before closing. That way you're in great shape. And their job really is to draft the documents to structure the exchange, hold the sale proceeds between the sale and the ultimate purchase, and really act as a sounding board. You can bounce ideas off of them, ask opinions, things like that. And we're here to kind of guide you. So that's our role at Exeter 1031 Exchange, is to serve as the qualified intermediary. A lot of folks don't cover this, but I think it's important because there's a lot of qualified intermediaries out there, and you need to know what to look for when you're selecting one. So number one is, in our opinion, top of the list is government oversight. You want to know someone's watching over their shoulder to make sure they're operating in a safe and sound manner. And like I indicated before, less than 1% of qualified intermediaries have any kind of government oversight, and we now do, licensed as a trust company. You want to check their bonding, check their insurance, and make sure they're using qualified trust accounts. Ask for samples, ask for evidence of insurance to make sure you're in good shape. The next slide is called qualified use or qualified use property. This is probably the most important slide in the deck. This is also where there's the most misinformation and the most confusion out there. So I'll spend a little more time on this one. We get a lot of investors who will call and say, do I qualify for 1031 exchange treatment? I only held title to the property for 9 months or a year or what have you. And they get hung up on the length of time that the property's been held. Now, the length of time helps demonstrate what your intent was, but it's not really the requirement. It's not the real issue. The real issue is you have to have the intent to hold the property, both the relinquished and the replacement properties, for some type of rental, investment, or business use. So rental is some type of cash flow. You acquire a property, you rent or lease it out, and you collect monthly rents. Investment, you can hold an asset for capital appreciation. It doesn't have to produce cash flow, but it does have to be held for investment purposes. Or you could acquire an asset to use in your business, maybe an office building, a retail shop, a storage facility, etc. So as long as it falls into one of those three categories, it'll qualify. So the real issue is, what was your intent? And so let me give you some examples. There's 2 tax court cases that were developers, both totally unrelated. Both were developers, both bought dirt, both intended to build single family homes and then sell like developers typically do. In this case, neither one built anything, they just held the dirt. One held the dirt for 12 years and one held the dirt for 20 years. They both ended up selling. They both ended up doing 1031 exchanges. Both got audited and both were disqualified because they didn't intend to hold it for rental, investment, or business use. They held it for development. Development is really held for sale, not held for investment purposes. Their intent is to really buy, build, and sell. It's really inventory in a real estate or real estate development business, essentially. So that doesn't qualify for 1031 exchange treatment. Now, if they had, somewhere in the middle there decided my model has changed, the business has changed, the real estate market has changed, and they communicated to everyone that they're now holding these assets for a capital appreciation, they're not going to develop them. Had they changed the way they reported them on tax returns, financial statements, loan applications, things like that, where it was listed as held for investment instead of held for development, it would have qualified. So intent can change, but you have to document it and explain it. On the flip side, we had one of our clients who sold a small single family, did an exchange, bought a condo, didn't read the CC&Rs until after closing. And after the closing, when they finally did read the CC&Rs, they found out that they were not permitted to rent the property. It had to be owner occupied. So of course they panicked and shot emails all over the place and immediately sold, did another exchange into something they could rent out. They were in the chain of title for about a month and a half. And as luck would have it, this was in California, they got audited by the California Franchise Tax Board. California allowed their transaction to proceed or to qualify because they could clearly document their intent was to hold for investment. They just didn't do their due diligence before closing. So again, you can see it's not the length of time, it's your intent that is critical. Now, the longer you hold it for rental or investment, the easier it is to prove your intent. That's why people get hung up on the length of time. It helps prove intent, but it's not the end all. So those investors who are in the business of buying and rehabbing or flipping or wholesaling, you're buying with the intent to hold for sale. Condo conversions, you buy apartments, you convert to condos, you really intend to sell. Those transactions don't qualify for 1031 exchange treatment. Now, if you were to buy, rehab, and hold as investment property, it would qualify. So it's all about your intent with that. And that probably creates some questions too. So if you have questions, feel free to post them in the chat function, and we'll certainly take the questions either as we go or at the end of the program. So this slide is kind of, we've already covered that. The holding period is not necessarily the end all. There's no specific requirements. You do get a lot of advisors who recommend, 12 months or 1 year and a day, 18 months, 24 months. Those are just opinions. I think that what it boils down to is if you buy property, hold it for a year, do a 1031 exchange, and then buy another property, hold it for a year. It's a plain vanilla 1031 exchange, nothing fancy. 12 months should be fine. 12 months straddles 2 tax returns. If you've got something weird with the transaction, if you're pushing the envelope, if you did live in the property at one point, or you ultimately want to live in the property you acquire at some point in the future, you may want to hold it for 24 months, which straddles 3 tax returns to prove it was really intended for investment purposes. And then your intent can always change later. This is the second slide that has the most confusion and misinformation out there. And this is actually really easy. From a like-kind property perspective, it amazes me. There's so much content out there, so many classes and seminars that still say if you sell a condo, you have to buy a condo. If you sell apartments, you have to buy apartments. Absolutely not true. Like-kind literally means you're selling real estate, you have to buy real estate. So any kind of real estate qualifies as long as it meets the qualified use test. So if it's held for some type of rental, investment, or business use, and it's real estate, it's going to satisfy the like-kind requirements. We used to be able to do exchanges for non-real estate or what we call personal property. That was taken away with the Tax Reform Act. So 2 years ago, we lost the ability to do 1031 exchanges for non-real estate, but nothing really changed on the real estate side. Here's a quick list of like-kind property just to kind of dig a little deeper here. Like-kind, again, is real estate for real estate. So all of these asset classes you see listed there qualify for 1031 exchange treatment or purposes. You'll notice it includes things you wouldn't necessarily think, like oil and gas rights, mineral rights, air rights, water rights, things like that are considered real estate under most state law. It also includes fractional ownership, like a tenant in common or a Delaware Statutory Trust. There's very few, if any, tenant in common syndications left today. There's all sorts of issues with them. So the Delaware Statutory Trust is the new structure that you'll hear more about, and that could take a lot of the risk out of the 1031 exchange process for you. A quick comment, this we could talk about for a long time, but non-like-kind property is anything held for personal use. So your home, your primary residence, a second home, a vacation home used for personal use, anything with excessive personal use is probably not going to qualify. But again, your intent can change. So there's a way to stop using it personally and then convert it to investment property. Non-like-kind property, with that we want to be careful. I just want to kind of throw this out there so you can think about it. If you own property in some type of an entity, corporation, C Corp, S Corp, partnership, an LLC with multiple members, so it's treated as a partnership, you really don't own real estate. You own shares of stock, or you own a partnership interest, or you own a membership interest in the entity, and the entity actually owns the real estate. So when you go to sell, we have to look at who's the real owner, who's the taxpayer in that particular transaction, and then drill down to see who qualifies for 1031 exchange treatment. So the most typical example is an LLC with multiple members. And with that, they decide to sell and they don't want to stay together. They want to break up. Well, what they're receiving is a cash distribution from the LLC upon sale. That doesn't qualify for exchange treatment. So we have to see if we can change maybe the membership interest, buy some of the members out, etc. There's ways to deal with that, but just the thing I want to leave you with there is if you own property in some type of an entity, give us a call, give your attorney or CPA a call, and see if there's issues today. Ask the question, what is your exit strategy? And then see if you're poised to do a 1031 exchange in the future, or if you need to make changes today to solve that problem. A quick comment on deadlines, because a lot of people already know these, but when the sale of your current property closes, you have exactly 45 calendar days to actually identify the replacement property. That's where most of the risk in a 1031 exchange occurs. With a regular forward exchange, you're selling first, and by doing that, you've triggered your taxable event. The question is, can you identify replacement property in time and close it within the 180-day exchange period? So again, when John presents, he's going to talk about that and how the Delaware Statutory Trust can really help solve that 45-day identification stress, if you will. But you do have exactly 45 calendar days to identify. And then you have an additional 135 days after the 45 days for a total of 180 days. So 45 days to identify, an additional 135 days to complete your 1031 exchange for a total of 180 days. The identification process is fairly straightforward. You have to identify during that 45-day window. These are the 3 rules you have to look at. Most people who are selling real estate, they sell one asset and they're buying one asset of probably equal or greater value. They're probably going to use the 3 property rule. They'll identify 3 with the intent to buy 1. In cases where you're going to go into the Delaware Statutory Trust, most of those investors will likely use the 200% rule. So the quickest way to learn how to use that is, let's say you sell an asset for $1 million, 200% is $2 million. You could identify as many properties as you want up to $2 million in value. So it's just 2 times whatever the sale price of your current property is, and that gives you the dollar limit, and you can identify as many properties as you want. And as long as you comply with 1 or 2 of those, you're in great shape. The 95% exception, be really careful with that. That's really designed for a portfolio acquisition. If you identify more than 3 properties and more than 200%, as long as you acquire and close on 95% of the value identified, you'll be okay. But if you don't, your whole exchange is disqualified. So in most cases, investors will stick with the 3 property rule if they're buying 1 asset of equal or greater value, 200% of fair market value rule if they're buying Delaware Statutory Trust. The reinvestment requirement, this is probably the third area where there's the most confusion out there. A lot of investors think that all they have to reinvest is their profit, their capital gain, their equity, the net sale price, or that comes out of the sale proceeds, I should say, that come out of the sale. And those are not correct. It really is the top level. You know, if you've got an asset worth $1 million, the government's really taken a position that you own this asset, it's worth $1 million, we'll let you defer the tax as long as you remain fully invested at that level. So if you sell for $1 million, generally whatever you acquire, if it's one asset or multiple assets, has to have a total value of at least $1 million or greater. There's a specific formula you can use if you want to cut it as close as possible. Most people trade up a little bit, so just the easiest way to look at it, if you sell for $1 million, buy for $1 million or more. The second thing to look at is all of your equity has to get reinvested if you want to defer all your taxes. Now, it's possible to do a partial 1031 exchange. People do it strategically all the time. So maybe you're cash, you know, real estate rich, cash poor, which is the case in a lot of real estate investors' portfolio. So maybe you sell for $1 million and you reinvest 900,000. You pull out 100,000 in cash. That's not going to hurt the 1031 exchange. And a lot of the material on the internet will tell you that you have to reinvest all your equity or you have to trade equal or up in value. Well, you have to if you want to defer all the tax. But if you don't mind paying some tax, it does not hurt the 1031 exchange. You just trade down in value or you pull some cash out, and that creates a little tax consequence. So sometimes that is not a bad thing to do if you're cash poor. Create a little liquidity for yourself and pay some tax. So trading down is okay. Pulling cash out is okay. Just talk to your CPA to find out how much you're going to pay. And then this is my last topic, and then we'll flip it over to John. So this one is a favorite slide of mine. This kind of shows how you can combine different exchanges and strategies together. So my favorite example is an actual client that we had, husband and wife, bought property in La Jolla, California, owned it and lived in it as their primary residence for 42 years, so long-term hold. They were having health issues, wanted to go back to the East Coast where their kids and grandkids were living, but they couldn't sell because their capital gain was $8 million, and that would have killed them tax-wise. Well, the IRS actually has a ruling that helps with that. And the ruling says you can move out of the property, convert it to investment, and then at that point, once you hold it long enough to show your intent was to convert to investment property, you can sell the property and take advantage of both the 121 exclusion and the 1031 exchange. So the 121 exclusion says that if you've owned the property and lived in the property for at least 24 months out of the last 60 months, so 2 out of the last 5 years, as a husband and wife, you get $500,000 in gain tax-free. So they lived there 42 years. They can clearly show they lived for 2 out of the last 5 years. Then for the 1031 exchange, you've got to show you intended to hold it for rental or investment purposes. So what we had them do is they moved out of the property. They moved back east with their kids and grandkids, etc. And then at that point, they converted the property to investment. They rented it out for 2 years. So that straddled 3 tax returns, very solid proof that that was the intent. Then they sold the property. And at that point, when they sold it, they get $500,000 tax-free, and they could do a 1031 exchange with the balance of that $7.5 million. So the first $500,000 in gain was tax-free. The $7.5 million in gain left over was tax deferred through a 1031 exchange, and they bought some really nice multifamily back in Florida with their family and whatnot. So great way to kind of deal with that. There's all sorts of ways to combine different types, you know, a forward into a reverse exchange, etc. We don't really have time to go into that, but just wanted to throw those ideas out there. So if you ever had questions, we'd be happy to kind of brainstorm with you. And with that, we're going to flip it over to John and let John take it from here on the Delaware Statutory Trust.
Thank you so much, Bill, as I'm waiting to show my screen here. Excellent. I'm going to start this slideshow. So I think the important thing to understand and really the takeaway is when you're doing a 1031 exchange, there are rules, there are guidelines that you need to follow. And just as you want to pick the best financial advisor and the best CPA, you want to choose a qualified intermediary like Bill that has been in this industry for a long period of time, that can walk you through scenarios. So I think there's a misconception that a qualified intermediary is a qualified intermediary. That's like saying an advisor, a CPA, they're all the same. So you really have to go with size, scale, and expertise. And we think that's very important. I want to echo what Bill mentioned about the timing. I get 1 to 2 calls a month, every month, from investors saying, I spoke to you a number of months ago, we want to do an exchange, and we just closed last week and I have $1 million in my bank account. And it tears me apart when I know that that client already has a taxable event. So I think one of my key takeaways for this audience is, if you have a property that's up for sale, if you're looking to start that conversation with the QI, start that conversation today. We don't want people to be forced into a taxable event, and the team at Exeter does a fantastic job. My role here is to give you a little bit of background on my company, Cantor Fitzgerald, and then just talk a little bit more specifically about using the Delaware Statutory Trust as a replacement option. Just as I mentioned, it's important to know and have a track record of your CPA, your advisor, and your qualified intermediary. I believe the same scrutiny should be done to DST sponsors. So just a little bit about Cantor Fitzgerald. Founded in 1945, offices in 6 continents right now, over 12,000 employees. We're one of the only investment grade rated Delaware Statutory Trust companies. And then finally, the United States government is our #1 client. We're one of 24 primary dealers of US Treasuries around the globe. And so a lot of our sophisticated institutional investors really like the fact that we work and are vetted all the way up through the federal government and the Department of Treasury. One of the other things that separates Cantor Fitzgerald is just the access and the fact that we have a world-class real estate organization in Newmark that is 90% controlled by Cantor Fitzgerald. We do every part of real estate on the commercial and multifamily side, whether that's investment sales, whether that's leasing, valuations, debt placement. We did approximately $70 billion of transactions in 2018, and in 2019, we did $85 billion of transactions. And why that is important to investors is we have 6,000 boots on the ground in the United States. And the more I learn about this world, the more that I understand that data and access to data is more important than ever. And we have a huge collection of data and a boots on the ground strategy that is very rare in the DST business. And we think it just makes us better investors over the long run. Bill did an excellent job kind of talking about the process of working with the qualified intermediary, the timeline, etc. So I am going to really just focus on the pros and I want to say cons of a Delaware Statutory Trust, also known as DSTs for short. Simply put, this is a business trust for real estate ownership. Simply put, a company like Cantor Fitzgerald can buy an asset. Is that an Amazon distribution center? Is it a large multi-family 400-unit apartment complex in Nashville or in Texas? The sponsor puts that asset in the trust. Once it's in the trust, investors have the option to fulfill their 1031 requirements that Bill went through, replacing debt and replacing equity, but you become an owner of the trust. And so what this accomplishes is many things, that we're going to talk about, but it's mainly passive ownership. You know what you're buying, but you're not dealing with the tenants, the toilets, and the trash, which some would say are the terrible T's. The downside of working with real estate is you have to manage it. There was an IRS code 2004-86 that established the Delaware Statutory Trust. So this business, is approximately 17 years old. There were some other structures like tenants in common that were also used for securitized real estate. But this is IRS code. This is not a theory. This is a major business now as we see baby boomers maturing and wanting to continue on that path of owning direct real estate. Bill mentioned the term swap until you drop, and maybe the last couple swaps are with a Delaware Statutory Trust to make life easier. So you can concentrate on grandkids. I usually say traveling. I don't think people are traveling as much with the pandemic, but you can get institutional management. And I think that's very, very key. I talked about access to institutional real estate. Usually at Cantor Fitzgerald, we're buying assets in the $100 to $150 million kind of price points. So not all individuals have the ability to buy that institutional quality directly and write that large of a check. So you get access to really high institutional quality real estate and management at as little as $100,000 investment. The passive ownership, I believe, is becoming more and more popular with baby boomers. And then also on the other end of the spectrum, younger investors who maybe bought a duplex 5 or 6 years ago somewhere on the West Coast, and there's been tremendous appreciation, but they don't have the bandwidth with kids and life and their careers to manage that real estate. So we're kind of seeing that barbell approach. Added diversification, for clients that have the majority of their net worth or a good portion of their net worth in one asset in a local area, there's risk there. So one of the advantages of the Delaware Statutory Trust is that you can work with multiple sponsors, and multiple sponsors have usually 2 to 3 programs going. So you can get a little medical office space exposure. You can get that Amazon warehouse, and you can fill in a couple of multifamily assets. So now that 500 to $1 million, you can spread and diversify by tenant, by industry, and geography. One other positive note is that the debt here, Bill did a good job saying you have to replace that debt. This is non-recourse debt, meaning your CPA, your enrolled agent is going to like that because you're not personally responsible for it. You get the benefits of depreciation, but it's non-recourse. A couple other items here. You're going to get tax reporting at the that start of the year, usually in March. And we use a grantor letter, which is very similar to a K-1. We talked about the minimums being $100,000. And again, this is just part of that estate planning, having flexibility and knowing where you are in your life and what you're trying to achieve. And we're just seeing a lot more interest in the passive ownership using the Delaware Statutory Trust. And then closing with confidence is something that we've kind of added. It seems like with the real estate world shaking a little bit with COVID, is that it's been harder to close assets. Financing has fallen through sometimes. Buyers and sellers not agreeing on pricing. One of the major advantages is if that you're on day 43 or day 44 of that 45-day ID period, you could literally select a Delaware Statutory Trust, do your research on it, work with, Bob Zink, a great advisor in this area, and be able to have confidence in closing as opposed to some of that anxiety that we have about whether assets are going to close during a pandemic. There are restrictions and limitations that I always really try to be fair and balanced. Some of these restrictions, investors have said, well, I see that as a positive. We just want to make sure our investors are making informed decisions. So some of the limitations are, these are illiquid. The Delaware Statutory Trust, most sponsors are asking investors to make a 5 to 7 or 6 to 8 year commitment, meaning you don't have the ability to call in 2 years and say, guess what, something has changed in my life and I want to sell this. These are illiquid, and there's no secondary market that exists for the Delaware Statutory Trust. And so investors need to understand that they're not controlling the asset. They're not, my dad used to own a lot of real estate, and he used to fix some of, the small projects on rental properties. You don't have to do that. And you're not involved in the sale of this. The trustee, so in our case, Cantor Fitzgerald, is going to make a decision with their fiduciary responsibility, trying to maximize the upside and provide liquidity when it makes sense in the market. So again, really want to be fair and balanced and not just talk about all of the upside that I think are very clear, but understand if there's a need for this money in the next 5 years or so, if the kids are going to college, if you're thinking about a remodel, we don't want to tie up this money for that period of time. If you kind of look at this, just this slide about the gain in popularity, we're continuing to see growth in this sector. And I think it's just become clear that at a certain age, people don't want to have a taxable event. They don't want to pay taxes, and they want to continue with the Delaware Statutory Trust as a way to fulfill those 1031 obligations. So before I transition back to Bill and we answer some of the questions, I just wanted to give a little bit of insight about what we're seeing in the marketplace now. There were some extensions that were granted for 1031 exchanges. It looks like there are going to be no further extensions, but at this point, I can't say that with certainty, but a lot of the industry magazines and articles that I'm reading saying there's not going to be further extensions for 1031s. And for people that are in cash or about to be in cash, it is a challenging time to find and close on replacement property. So perhaps using a Delaware Statutory Trust as a first option makes sense, but also we work with a lot of advisors and investors who the Delaware Statutory Trust is not their first option, but it's a great backup option to include with all of the uncertainty in the real estate market. Because if you're at the end of an exchange and you're not going to be able to close on something, the fact that the asset and the financing and the turnkey solution is there in the Delaware Statutory Trust, we're seeing investors really like that, although it's not an insurance product, kind of having that insurance policy, meaning we could go with the DST so we don't get a large tax bill. And I think that is very timely with the market that we're seeing right now. So with that, Bill, I'm going to kick it back to you. I'm going to stop my screen share and I will stay on for further questions.
Okay, that sounds good. But, one of the things I like the best about the DSTs also is we'll get clients who sell relinquished property and they're in the middle of an exchange and they go to acquire replacement property, and all of a sudden they find out for whatever reason, maybe it's they're self-employed or they have no earned income or they're retired, et cetera, and they can't qualify for any financing. And as you pointed out, the DSTs, the financing's built in, so they really can just buy a fractional interest in the DST and not have to worry about going through the whole underwriting process with the lender.
So Bill, I can add a little bit of color to that. I'm refinancing my home right now, which I thought was going to be a simple process. And it takes you a week just to put together the documents for this loan process. And the other thing about loans right now is I know everyone has great credit on this webinar, but a company like Cantor Fitzgerald, that's a preferred borrower from Freddie and Fannie, I would argue that we could probably get more attractive interest rates than individuals on their own. So we're financing a couple deals that we're locking in this week, and I believe we're going to be, sub 3% in financing. And just another aspect of the Delaware Statutory Trust, that a company like Cantor that's been doing it so long, we can probably achieve stronger financing than some individual clients on their own.
Now, one of the questions we get from clients a lot too is regarding the closing process. Could you kind of give them a quick overview as to how the closing process would work if they identify and acquire a DST?
Yeah, so we want to always work with them to get that included in the 45-day period. And basically, when investors know how much equity that they want to invest, we work with them. We work with the team at Exeter, and we fine tune the equity amount, the debt that they're going to inherit on this asset. And there is paperwork that needs to be completed. We work with you and the advisor through the process. And the good news is we can usually close within 72 hours if an investor wants to, meaning it's on day 44. Let's go with the Cantor Delaware Statutory Trust. We can start paperwork there, reach out to the qualified intermediary, and you can be cash flowing, accruing distributions on a daily basis 3 or 4 days after you've been in cash if you'd like. So the ability to close and shorten this process, again, is very attractive in the Delaware Statutory Trust sector.
Piggybacking on that a little bit, Bill, sometimes an investor, this is their only asset. It's an apartment house they've had forever, and they need that cash flow to continue on a monthly basis. With the DST, they can do that. As John mentioned, you can close in a matter of 3-4 days, start accruing cash in the next month, get a check or a direct deposit, whichever you choose. And the other thing we've talked about some, but I see it more and more being a real estate broker also, is the lending environment, even for people with great credit, is very precarious today. And lenders will change terms at the last minute or say, well, I know we said we'd make a 70% loan on your up leg on the apartment, but we're going to make a 60% loan. And they don't have that 10%. Mm-hmm. So you not only don't have to qualify for the loan and on the loan, but you don't have those loan issues because the property's already closed. It's already taken care of.
Yep, absolutely. And we've seen also folks that'll proceed with a 1031 exchange and buy the replacement property, and then they'll have a sliver left over, 50, 75, 100,000 in cash. And, before the DST was here, in that case, they would just have to pay tax on whatever the balance is. But now with the DSTs, they can use up that balance and not pay tax on any of it.
Yeah, good point, Bill. Thank you.
Yeah, John, this is Mark.
Sorry, Mark, go ahead.
Yeah, just going to jump in real quick because I'm glad you mentioned the time frame in the 45 days, because I do get questions quite a bit from our clients wanting to do the DST and wanting to know when to engage with you all in the time frame, making sure that everybody has what they need in proper time. So the fact that you mentioned that how quickly you guys can turn that around is really impressive. So because I tell them talk early, get you guys as soon as possible.
And I think that's the big takeaway from all of us to kind of summarize that, is that getting the qualified intermediary, getting Bill, Mark, and their team involved when that asset is on the market, I believe is the best time to get that paperwork. This is a process. This is a process with a tax consultant, if that makes sense, with an advisor. So again, I just think it's so important to understand the history of these companies and the team members that you have, because everyone has a specific role, and you just want to make sure you have first-rate professionals, because I won't speak for Bill, Bob, and Mark, but I cringe when I hear about misinformation being out there. I cringe when we hear investors say, I'm so excited, John, we're going to do that Delaware Statutory Trust, and it was the money just got wired into my account. And so I think the key takeaway is just bringing in the professionals, every aspect of this as quickly as possible, because it just pains us when people are trying to avoid taxes and for some reason or another, they get stuck with a taxable event.
Well, and I think too, having somebody like Bill who will point out to people that there are reverse exchange and improvement exchange, but also something that a lot of people don't understand, but it's not an all or nothing issue. If you want to keep $100,000 out of your $600,000 for the trip around the world that you owe your wife or kids, you can do that. It's one of those things that's very flexible, but you want somebody like Bill and Mark on the team and involved early, and so you know what options are available and get it done ahead of time.
And let's see, any other questions from the audience? Anybody? Now's the time to get some free advice. If you want to throw anything out there, I'd be happy to brainstorm with you. And kind of piggybacking on the last chat, the almost anything can be fixed if it's before closing, but after closing, very difficult to fix it. So like John said, get your team together, and that should include everyone on the webinar today, and then also, your tax advisor and maybe even an attorney, just to quickly review everything. If you find, now's the time to poke holes in what you're trying to do and find problems, because they can either be fixed or may change your mind before closing. Once the closing occurs, there's almost nothing that can be done. So just get the team together beforehand.
Yeah, good point, Bill. That's the other thing that I'm sure you see is it's owned in an LLC and several partners, and now they don't want to all go together. And they say, well, we want to do this and this, and it's too late, typically.
Yeah. And there's a whole bunch of ways that might be able to solve that problem. It depends. My favorite answer is it depends. I could see Mark smiling there. Mark,
yeah, right. That and the fact that I got a call, they'll say, yes, we're an LLC multi-member, and we're all going in together through it on the other end. I'm like, fantastic.
Yeah. That one's a rare event. I think they always want to break up.
Right. I've got one this week. So
that's definitely my experience. Don't worry, we're all going to go together. Day 42. Guess what? We're going to have to do a swap and drop here and get some attorneys going quickly on this. So
yeah, got a lot of
excellent, gentlemen.
So far, it looks. Oh, we may have a question here. Let me see if I can open that up. The question is, can you invest in a DST directly with a sponsor like Cantor Fitzgerald without going through a broker?
Yeah, the answer is unfortunately no. These are financial transactions. They're securities. So it's not a real estate agent. This is not a typical real estate transaction. It's a securitized 1031 exchange. So the direct answer is no. And then just a little bit more color. You want someone like Bob Zink, who has experience almost 2-3 decades in real estate and the securities, to be able to navigate that process. Delaware Statutory Trust or securities, you get a lot of information. And for people that aren't used to going through a 200-page document, Bob does an excellent job. And so again, sometimes we feel people trying to avoid a financial advisor, and my experience is that leads to more problems down the road because these transactions can be complicated, and that kind of goes back to bringing in people that have experience. I call it downside protection, and you just don't want to have an issue 2 years down the road, as Bill mentioned. When with the IRS coming back to you saying, let's dig into this transaction a little bit more. That's when people really want that experience.
And it's a lot easier to go through what's available when you're ready to buy, when you're going through Bob, and kind of narrow it down. And Bob's firm has done a lot of due diligence on the properties, can answer a lot of the questions. You can quickly hone in on what's right for the investor. Doing that on your own would be a pretty daunting task.
The other, we've talked about the time that Exeter has been around, and Cantor, having been in the real estate and securities business for a long time. I'm part of 2 national exchange groups, the Society of Exchange Counselors and the National Council of Exchangers. So I have broker relationships across the country and can check out property and situations overnight. If the client says, well, what's the market like in Nashville? Well, we can find that out and check those things out. Not to mention, if you look at a Cantor Fitzgerald offering memorandum, everything you'd want to know about that property is in that document, but it does mean you're going to wade through 250 pages of details that the securities commissioner has had lawyers bless. So sometimes it can be an onerous task.
And to add to that too, on those 2 groups you're a member of, a lot of times we'll have clients that are kind of forced to do something creatively to get a deal done, maybe seller carryback financing or all sorts of things. And those groups have a lot of people in there that have some significant expertise like you that can kind of look at the challenges that are presented to the client and then find somebody in the group that can help that particular situation.
Yeah, that's a good point, Bill.
And let's see, any other questions? It looks like that's all for now. If you have any other questions, post them quickly. We'll go ahead and address those. Otherwise, Bob, do you have any wrap-up comments?
Well, I just think the big wrap-up, Bill, is for people to understand that the flexibility of the DST is almost limitless. I mean, you can go into multiple markets, multiple property types. I've had clients say, this is my last real estate deal, but I have 3 kids, so they go into 3 DSTs, so that upon their demise, the 3 children are each going to get their own DST, and then they can do what they want down the road. So it's a very flexible asset, and they aren't burdening their children with real estate decision-making issues that they may not be qualified or may not want to. Today, I look at my kids who are all out in the workforce. They don't have any time to deal with active real estate management, or 2 of them inclination. One of them could, but the other 2 would have no idea what to do with it. So it's a very flexible tool, both as to property type, market, and estate planning.
And if you do, if you go out and do an exchange and buy your own asset, one of the things we've seen quite a bit in the trust world is that means that the kids end up owning or inheriting probably one large asset, and then you have 2 or 3 or 4 kids trying to manage that together. And talk about trying to herd cats and or avoid family feud is amazing, where if you get multiple assets or a DST that you can chop up or split up between the kids, and they don't have to fight over it. They can each have their own asset.
Well, and it's amazing, Bill, how many people say, but my 3 children get along. All right. Now there's 2 or 3 spouses to those children, and that they don't get along.
Yes.
Yep.
My kids get along, but I have 2 children that are married, and those spouses don't get along. So getting a trust, the spouse says, yeah, but half of that asset's mine, and I don't like so-and-so.
Yep. And it's funny how they do get along until money's involved.
Oh, yeah. Good point.
Completely.
You want
John,
to do what?
any wrap-up comments, John?
Yeah, I just think I'll kind of start, or I'll end where I began. You've got to surround yourself with experts. Bill and his team, Mark, do a great job at Exeter. I think that experience really came out. Bob Zink does an excellent job in helping people select Delaware Statutory Trust. So I just think in the environment we're in today, Cantor Fitzgerald does a really good job of delivering on these offerings, and just think about it as the main solution or an auxiliary solution that you may look back at 3 or 4 years down the road and say, wow, it was so great that that $200,000 or $300,000 that was going to get sent to Uncle Sam was working for me and my family. And so just don't discount the potential upside of using a Delaware Statutory Trust to fulfill your 1031 obligations. And Bill, Mark, Bob, I appreciate the opportunity.
Yeah,
Absolutely.
Thank you, John.
Mark, any final comments?
Just to say, like, the DST makes a lot of sense, especially in the COVID environment we find ourselves. And, you know, working with John and working with Bob here, just two outstanding folks in the space that will really be able to help the clients. So reach out to them, and anything we can do to you know, work together and help each other out, definitely will do that. But just one of those things with we will look to see that there's a lot of opportunities still moving forward through all of this, and the DST is still gaining strength, and just like John pointed out, it's very popular, and that graph was pretty impressive.
Perfect. Well, thank you everyone for participating, joining us today. Any follow-up, last minutes, last notices, last comments, last questions? Going once, going twice.
Yeah.
Thank you everyone. Hope to see you next time. Look forward to working with you. Take care.
All right. Thank you, everybody.